Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we have a fairly robust econ show today. There's a lot to talk about just based on everything that's happening in the world. We're filming this on Wednesday, so we're going to have a lot of information coming out shortly on what's the Fed going to do, rate rises, when is that going to happen, timing of it all. So we'll try to kind of fold that in as it comes out. We're going to start off with looking at Russia again. We talked about it at the end of EIA segment, at the beginning of EIA segment 3. And we want to look at what's happening in the Middle East as well. But in that backdrop, by looking at what has happened and what are the expectations for global inflation, GDP growth for 2022, and how is that going to be impacted based on things that are happening around the world. So U.S. leading indicators in segment 2, we're going to go through U.S. leading indicators and how, as we've been talking about, we've had some economic activity start to slow, and how long is that going to last? Then we're going to look at real estate prices. Where is real estate right now? What are the expectations? How are sales moving with the consumer? And then when we turn to Europe, we're going to look at producer prices, how they continue to rise, inflation. And then when we turn to Asia, we're going to look at China, and we're going to talk about, can liquidity fix some of this? How much liquidity is coming through? What does that mean in general? Is there enough? Isn't there enough? There's a lot of things to discuss, and how trade is shifting around other nations and not just within China. So now that we provided some of that update in terms of where things are, we're going to just dive right into this chart, which I think is a very good one, just kind of showing you where things are outlined. There's nothing labeled in Belarus right now, but just to give you an idea, there is something just north of Kyiv at this point. So I'll talk about it, but I just won't have it in visual. So here you can see just where things are, how many things are in place, just given, artillery, armored vehicles, tanks. There's a significant amount of activity, and you can see that it's essentially 3 fronts. They could go north from Crimea. You can come east to west when you're coming just straight across, and then south from Kyiv on the Russian side as well as the Belarus side. So this is where we sit. There's been zero, and I mean zero reduction in terms of assets in place. What is there? What is being moved around. So I think this is a very important component when you're looking at how things are going to play out, because when you look at these assets, how things are going, you have to look at where is their availability. And you have a lot of heavy equipment, these tanks, these armored vehicles. They need frozen ground, because there is that thaw that happens. And if you have that thaw, you're not getting things across. So February is kind of this is a very important piece of moving things and again, either making the decision to continue or not. As we've been highlighting in terms of some of our views in general, the views remain the same. When you look at the timing, we don't think there's anything that's going to happen. That we do think that there is a very strong move to show that they are still on the world stage. There's a lot of economic incentive to make sure that NATO doesn't continue moving west to east, some of that equipment doesn't continue to move through, and that some of these countries will never be allowed to join NATO just in terms of some of those movements. But it's also making sure that they can continue to sell gas, oil. What does that look like? Because at this point, oil continues to be a huge consumption for what is coming from Russia into Europe. So when we look at where things are, right now tensions are increasing. Russia continues its military buildup. We've had combat troops, hundreds of aircrafts, S-400 systems, which are anti-missile, anti-aircraft systems, have been deployed to Belarus. So again, there's nothing yet. Currently, there's around 100,000 troops on the Ukraine border and has them surrounded on the 3 fronts, as I've been talking about. One of the big things when you look at the U.S. continues to send assets into I should say equipment. NATO continues to send equipment. Some people have sent personnel. So there are a lot of things that have been moving into the Ukraine to help try to counter and show strength. So while this is continuing to play out, there are more things happening around the world. When you look at where things are right now, the UAE had engaged their Patriot and THAAD battalion to stop a recent missile attack that came against Abu Dhabi. So surface-to-air missiles launched at the incoming drones and missiles of Houthi rebels were fired northeast of Abu Dhabi. A Patriot PAC-3 and a THAAD battalion are based there to protect the capital. So Iran-backed Houthi militias have also launched a ballistic missile on a civilian neighborhood of Marib. So you're seeing, again, that's where I think you can have some fairly sizable problems in the near term. Then when you look at IRGC-backed Houthi rebels just conducted another attack again in Abu Dhabi. So you're going to have this response. There's been a little bit of a slowdown. We're still trying to understand what is the UAE going to do. Is there going to be some adjustment? But this is, I think, more near term where you could get something in the next week or two, where things that are happening in Russia, Ukraine is more of, middle to end of February. Not to say it couldn't happen right now, but that's how I would kind of weigh where some of these potential risks are. Now, when you look at Russia, because there's been talk that if they make a move on Ukraine, they would lose the ability to use SWIFT. And this is just showing you how much Russia has built up on their gold and Forex reserves and how they have been amassing it over time. And it's something that has been, again, a key piece to try to insulate themselves. And there's talk that if they lose the SWIFT, then they will ask China to trade with them in ruble and not in US dollars. So it's just something to look at and consider, because again, typically most of these wars, these conflicts don't happen in good times, but in bad. And so it's important to look at what would happen, what would the economic impacts really look like. Now, when you look at European gas inventories, they still remain very low. It's at the low end of that curve when you're looking at versus what is historical. The weather is obviously going to play big into what this is. There's an expectation that power gen is going to come down, which is going to pull more natural gas and coal back into the forefront. Now, when we start looking at where infrastructure investment gaps remain, again, I have an energy infrastructure fund, which I think is very important given the fact that we do have these very broad shortfalls that have to be addressed. This is just looking at infrastructure investment gaps and recent fiscal packages. So the estimate for the infrastructure investment gap, as you can see in the U.S., is close to $4 trillion. So we're only scratching the surface of what needs to happen. And when you look at European Union, something similar, as well as other advanced economies, there is a lot of opportunity to invest in infrastructure, especially on the energy front. Green bonds still remain front and center. So when you look at global green bond issuance, the actual versus the forecast, so there's a lot of expectation that you're going to continue to see green bonds. There's a lot of demand for them. So I don't see this, again, I do see this continuing, especially on a global level where Europe continues to put these into the market. Now, a sharp slowdown in China, and what would that do to the global economy? And I think that the OECD put this out, which I think is an interesting backdrop to give you an idea of as China continues to slow, or if there's a bigger shock, what would the fallout be? And you can see that the GDP at constant prices, you kind of get the gist of where the pain would be, how that would happen, and how it would hit the U.S., pulling down GDP by about 1.6%, and some other areas by about 2%, which is why we talk so much about China. What does the slowdown look like? What is happening to try to offset it? Because there would be a fairly large impact to the global economy as they continue to slow and as there's a bit more of that pressure. Now, when you look at what that rebound looks like, so taking into account that China continues to do what it's doing, the IMF predicts that global growth will moderate in 22 and 23. There's a lot of reasons for that. There is a backdrop of you have the slowdown on the fiscal and monetary front when you consider where some of those pressure points will be. So those slowdowns, you get that fiscal monetary drag that pulls things lower, and then you have that overhang of what is China going to do? What is that pressure going to look like? So expectations for 2022 have been cut to 4.4% from 4.9%, with U.S. and China driving the weakness. Annual inflation rate projected at 3.9% within advanced economies, and then supply chain disruptions as key issue. So we continue to see the estimates come down. Again, we expect this to continue to be revised lower. We think there is more pressure out there. Now, when we look at the ratio of global trade to output, it's been flat for about a decade, and just based on what we're seeing, we don't see that changing. If anything, it's going to essentially rejigger as to where the industrial production is happening, because we're not seeing a big increase, just a moving of the pieces from. And this is why when I talk about China and I talk about supply chains and pressure on their production, it's more about this shift. It's going to be a shift from China to somewhere else, not in addition to. And this, I think, paints that story well. Then when we look at where the growth is going to come from, a lot of the expectations is that growth is going to come from a mostly unfree nations, and that's looking at the China, Asia in general, and where the growth. And then by 2050, only 26% of global GDP will come from free and mostly free economies. Again, this is a projection. I disagree with it, just because typically those mostly unfree tend to fall into a problem, and then you get a bit more freedom just to keep things moving, because we know price controls typically fail in the long run. Now, when we look at inflation above target, the share of countries, when you look at 2021, were over 50. Inflation forecasts for emerging market and developing entities. Central banks, you can see just where the forecast is and where the inflation target remains, and why we continue to believe that we will see an additional rise in rates over the coming few months. And to give you an idea of where the rate hike forecasts come, this is when you look at emerging markets, the average policy rate shift. You can see that the Q4 2022 forecast continues to come closer to 4 to 4.5%, just as we get more rate rises as we come from the emerging markets, again, as they try to get that inflation under control. So when we think about why, this is when we can turn to the Taylor type rule and why we continue to see some of the pressure points. Turkey, India remain behind the curve in terms of raising rates, which is why we think that there's additional pressure into Europe, because Turkey has that exposure into Europe, and India is going to have to get a bit more aggressive in the near term to try to bring some of this under control. And then when you look at China in terms of where some of the pressure points are, even though there's a lot of talk that China is going to ease, they're a bit hamstrung based on where things are right now, how things are situated, and you can see that they're really not at the low end, and that's why, we hear about China easing and what that means, and we've done a lot of work on it. We've talked about it a lot. It's not that they're going to ease, they're just going to stop going down, and that's something that we're going to talk about a bit more in segment 5. High beta emerging market debt remains the most vulnerable to the U.S. Treasury, which is why I think it's going to be important based on what does the Fed say, how do they project when quantitative tightening happens, when we get some of these cuts in buying of not only Fed bonds, I should say treasuries, but also emerging market, mortgage-backed securities. So again, that's another pressure point that a lot of these countries are going to try to stay ahead of as we get some of these additional pressure. Now, inflation predictions, they're always wrong, just based on the nature of the game, because you can see that the shift continues to go higher. This is looking at December versus May versus September versus December of 21. So you can see that there's an expectation that that you still get this big drop off in inflation. We don't see it. We still see inflation as very high, which is why we continue to see this pressure and not a big drop off, but essentially staying elevated. And one of the things that gives me confidence of that is you can see how wrong the estimates have been. And for those that have been watching us, how right we've been in terms of where inflation is going and how sticky it's going to be. And now, when we look at what the Fed decision is, we'll see, how much pressure is going to remain in the U.S. So then when you look at core inflation rates, this gives you an idea of how we continue to see a shift on the OECD nations, United States, U.S. approaching closer to 7%. When you look at OECD nations now approaching over 4%, G7, this is just kind of giving you the indication of how elevated inflation is, how things are going to remain fairly elevated for an extended period of time. And why is that? Well, let's look at U.S. containers. So empty outbound containers have been running higher, which is good, trying to refill some of what has been lost when you look at the shortage of containers around the world, especially in Asia. As we've been importing a lot, we have to export these containers again. So this is helping to again, a big piece, I should say a big part of the supply chain struggles, why there continues to be a lot of this conflict, which is why we continue to see this coming back into and an important piece of fixing that. But while this is happening, Shanghai to LA container freight benchmark rate still remains elevated. You can see it's come off the highs, but again, still elevated, still not coming down all the way. And as we talked about in the EIA show, there's a lot of ships still sitting offshore, which is going to keep those prices higher. Now, when you look at suppliers, delivery times have caught up a bit. And as we've been saying, they would catch up and then kind of go sideways. And we still think that that is the case here, where you're still going to have some of that support as we go into the end of Q1. Labor markets in advanced economies, we're moving much closer to full employment in the U.S. as well as in other areas, which when you think about the dual mandate of the Fed, the dual mandate is full employment, inflation. Well, we're right at, if not right at or near full employment, and inflation is moving up and closer to 7%. So we should see some sort of activity in terms of when that's going to happen and when that will be. So then when we look at what is happening on the emerging market, 3-month change in flows, you can see that net flows still remain under pressure. The uncertainty around the U.S. Treasury, even though if you look at the numbers, it looks like a good move, but it may be a bit pressured based on what is going to happen with Treasury rates, because the 10-year is very important to look at. How is this going to impact? And then what are central banks going to do within these regions as inflation remains a big concern, also because of the supply chain and food. So looking at some key growing areas, here you can see Europe is a grains heavyweight, which is another reason why when you think about Russia, some of the concerns there. But when we consider what has happened in the U.S. and what has happened in Brazil, the good versus poor continues to skew towards poor, which is a bigger problem. So outlook for this year's crop yield is down in South America. Planalytics on Wednesday declined. They took down their estimates for what is going to happen on the soybean front. So we have it for soybean and for corn. So first corn. So the estimates have been taken down from 3.59 to 3.56 in Mato Grosso. Parana, 3.19 to 3.12. Rio Grande do Sul, 3.06 to 2.8. And Gayos from 3.7 to 3.68. So again, seeing a lot of this reduction. And then when we turn to soy, the outlook has gone, the forecast to 2.85 from 2.86. And a lot of this is just because of those heat waves that we've been talking about and how dry the soil is, putting additional pressure on the growing cycle. And this is again tightening up the global supply chain, tightening up the amount of crops that are available, which is a huge issue, especially when you look at China continues to be a big buyer of grain stocks, and they've been absorbing it. How much of it is for safety? How much of it is to refill some of the coffers? There's a lot of unknowns in that, but again, China continues to be the biggest buyer and is absorbing all this now. So increasing demand, decreasing supply, creating a lot of the stress that we see. Now, on the other side, when you look at fertilizer prices, so one measure of European fertilizer prices jumped fourfold and continues to be at near all-time highs, which again is also going to keep prices for food elevated and the pressure points. Weekly U.S. corn export inspections to China Still remaining elevated. Again, a lot of these movements continue to move into the market. And then when you look at weekly inspections, U.S. corn and soybean export inspections last week were not as high as the week prior. Some 347,000 tons of corn was inspected for China, along with 641,000 soybeans. Wheat inspection were average for the date. So again, still staying fairly average, but trending towards the higher end, especially when you look at what China has been buying and what is available in the market, keeping a very firm footing in grain prices. I mean, we have soybeans up $35 because of the rework on what South America is going to produce and the pressure in South America. If you think about January is a very important month, but February is also one of the most important months. And just based on how it was in Jan, how it's continuing in March, in February, is going to be a detriment to what yield is going to look like, putting us in a bigger supply crunch as we head into 2020, as we head through 2022 and into 2023. Keeping a bid beneath foodstuffs, which is obviously also very important when we're looking at inflation, and keeping that inflationary bid beneath us, which is why, again, I don't see inflation as temporary, but something that's going to be sticky and giving way to that stagflation. So now in the next segment, we're going to go deeper into what's happening in the U.S. and what did the Fed come out and say.